Did you know that a single refinancing mistake in 2026 could easily cost you over $30,000? Many homeowners jump into refinancing without understanding the true long-term costs, often lured by a slightly lower interest rate, only to realize years later they actually paid more. This isn't just about closing costs. It's about the entire financial picture and how a seemingly good deal can quietly erode your home equity. I'm going to show you exactly how this happens and, more importantly, how to avoid it so you don't become another statistic. The biggest trap lies in extending your loan term, but that's just the start. What most people overlook is how quickly those small fees add up, and I'll break down the numbers for you, revealing the precise moment refinancing becomes a smart move. At its core, refinancing your mortgage means replacing your existing home loan with a new one. The primary goal for most people is to secure a lower interest rate, which translates to reduced monthly payments and significant savings over the life of the loan. But it's not the only reason. Some homeowners refinance to switch from an adjustable rate mortgage, ARM, to a stable fixed rate, gaining predictability. Others might want to remove private mortgage insurance, PMI, or even tap into their home equity through a cash-out refinance. Each of these reasons has its own set of pros and cons, and understanding your motivation is the first step toward avoiding that $30,000 mistake. But here's the crucial question. What specific market conditions in 2026 make now the right time, or the wrong time, to even consider it? The most common and often best reason to refinance is when interest rates drop significantly below your current mortgage rate. Let's say you bought your home in 2023 with a 6.5% interest rate on a $400,000 loan. If rates in 2026 fall to 5.5%, that 1% difference might seem small, but it's huge. On a 30-year fixed loan, your original payment would be around $2,528.26. At 5.5%, it drops to $2,271.29, saving you $256.97 every single month. Over 30 years, that's over $92,509.20 in interest savings. This is the dream scenario, but it's not a guaranteed win. You still have to factor in closing costs, and that's where many people stumble. The real trick is knowing how to calculate your break-even point, which I'll show you next. The break-even point is the moment your monthly savings from refinancing offset your closing costs. Let's stick with our example. You save $257 per month, but the closing costs for your new loan are $8,000. To find your break-even point, divide the total closing costs by your monthly savings. $8,000/$256.97 equals approximately 31.13 months. This means it will take you approximately 31.13 months, or just over 2.5 years, to recoup the money you spent to refinance. If you plan to stay in your home for longer than 31 months, refinancing makes financial sense. If you anticipate moving sooner, you'll actually lose money. This calculation is absolutely critical, yet so many homeowners skip it, leading directly to that $30,000 mistake. But what if you're not just looking for lower payments but need cash? A cash-out refinance allows you to tap into your home equity, converting it into liquid cash for things like home renovations, debt consolidation, or even investments. While it sounds appealing, this is a prime area for making that costly mistake. Let's say your home is worth $500,000 and you owe $300,000. You could potentially refinance for $375,000, pulling out $75,000 in cash. However, you're essentially taking on a larger loan, and that $75,000 now accrues interest for the next 30 years. If your new interest rate is 6%, that $75,000 could cost you an additional $80,000 in interest over the loan term. It's not free money. It's borrowing against your most valuable asset. The trick is to only use a cash-out refinance for appreciating assets or high-interest debt. But even then, there's a hidden risk. Many people consider a cash-out refinance to consolidate high-interest credit card debt. While replacing 20% credit card interest with 6% mortgage interest seems like a no-brainer, it's a common trap. Here's why. You've now converted short-term, unsecured debt into long-term secured debt against your home. If you default on your credit cards, it hurts your credit score. If you default on your mortgage, you lose your home. It also gives you another 30 years to pay off that original debt, meaning you could end up paying far more in total interest. For example, if you roll $20,000 of credit card debt into a 30-year mortgage at 6%, you'll pay about $23,000 in interest on that $20,000 over the term, assuming you don't pay it off early. The key is strict financial discipline, which most people don't have, and that's the real problem. Private mortgage insurance, or PMI, is an extra fee you pay if you put down less than 20% when buying your home. Protects the lender, not you. Refinancing can be a fantastic way to eliminate PMI, saving you money every month. If your home value has appreciated significantly since you bought it, or you've paid down a substantial portion of your principal, you might now have more than 20% equity. For instance, if you bought a $350,000 home with 5% down, $17,500, and it's now worth $450,000 with a $300,000 loan balance, you have $150,000 in equity, or 33%. Refinancing would allow you to drop that PMI, which often costs $100 to $300 a month, directly into your pocket. However, this strategy only works if the new loan's closing costs are outweighed by your PMI savings, and that calculation is often missed. For homeowners with FHA or VA loans, there are special streamlined refinance options that can be incredibly beneficial. These programs often require less paperwork, no income verification, and sometimes no appraisal, significantly reducing closing costs and making the break-even point much shorter. An FHA Streamline, for example, allows you to refinance your existing FHA loan to a lower interest rate with minimal hassle. Similarly, a VA interest rate reduction refinance loan, IRRRL, helps veterans lower their rates or switch from an ARM to a fixed rate without requiring new credit checks or appraisals. These are powerful tools, but they're not always advertised widely. The catch? You generally must already have one of these loan types. Don't overlook these specific programs if they apply to you, as they represent one of the clearest paths to saving money without the usual refinancing headaches. Your credit score is a major factor in the interest rate you'll qualify for. A higher score means lower risk to lenders, translating into a lower rate for you. If your credit score has significantly improved since you got your original mortgage, perhaps from a 680 to a 740, refinancing could lock in much better terms. Even a 0.5% difference on a $350,000 loan can save you thousands over the loan's life. Before you even think about applying, pull your credit reports from all three bureaus, Experian, Equifax, TransUnion, and dispute any errors. Pay down any outstanding credit card balances to boost your score. This proactive step can easily save you thousands in interest, but most people wait until they apply, losing out on a better deal. The worst thing you can do is apply with a suboptimal score. Refinancing isn't free. Just like your original mortgage, you'll pay closing costs, which typically range from 2% to 5% of the new loan amount. On a $300,000 refinance, that's $6,000 to $15,000 in fees. These costs include appraisal fees, title insurance, lender fees, and potentially points to buy down your interest rate. The $30,000 mistake often starts here. People don't fully account for these costs. Some lenders offer no closing cost refinances, but beware, these aren't free. The costs are usually rolled into a higher interest rate or added to your loan balance, meaning you pay more interest over time. Always ask for a detailed breakdown of all fees. Understanding these charges is crucial for an accurate break-even calculation, and not all lenders are transparent upfront. This is the big one that leads to the $30,000 plus loss. If you've been paying on a 30-year mortgage for 5 years and then refinance into a new 30-year mortgage, you've essentially reset the clock. You're now paying interest for 35 years instead of 25 years. Even with a lower interest rate, the total interest paid over the extended period can be far greater. For example, if you had 25 years left on a $300,000 loan at 6% and refinanced to a new $300,000 loan at 5.5% for 30 years, your monthly payment might drop by $100. But the total interest paid over the new 30 years will likely exceed what you would have paid on your original 25-year term. Always try to refinance into a shorter term, like a 15-year loan, or at least keep the remaining term similar to your original loan. Otherwise, you're just kicking the can down the road, and the bank wins. Before you even talk to a lender, take these concrete steps. First, calculate your current equity. Research recent home sales in your area on Zillow or Redfin to get an estimate. Second, pull your credit report and optimize your score. Third, gather all your current mortgage documents, including your original closing statement and recent statements. Know your current interest rate, remaining balance, and original loan term. Fourth, use an online refinance calculator to estimate potential savings and closing costs. Get at least 3 quotes from different lenders, a national bank, a local credit union, and an online lender to compare rates and fees. Remember, the lowest interest rate isn't always the best deal if the closing costs are astronomical or if it significantly extends your loan term. This preparation will save you thousands. But there's one final trick many miss. The key takeaway for 2026 is that refinancing can be a powerful tool, but only if you understand the total cost and avoid extending your loan term unnecessarily. Always calculate your break-even point and consider your long-term goals. Don't let a seemingly low monthly payment blind you to the total interest paid over decades. If you're wondering what happens when your home value drops right after you refinance, potentially putting you underwater, then you'll want to watch our video on that exact scenario next. We break down the risks and what you can do. And if you found this information valuable, please consider subscribing for more insights into smart real estate decisions.